Joining us now is Rashaun Williams, Value Investment Group founder and Atlanta Falcons Limited partner. Rashaun, happy pre-4th. Good to see you. So I'm curious about the how software is playing in here specifically. It's one thing if you're a Databricks, and I know that's software, but it's also like data and very, very AI focused and already at scale. Publicly traded software companies, the smaller ones, the ones that IPO'd more recently, are not performing well at all. So how does that affect the outlook for a VC?
Yeah, I think it's the tale of two IPOs, right? So you have the Databricks of the world, just like you mentioned, who are trading around that 18 times type of multiple, but very in line with a Snowflake and a Palantir, which is trading around 17 times. And then you have all of the rest of the crew, like the Turos and the Klarnas, even that's fintech coming through, and they're trading at a fraction of that. I mean, literally like anywhere between 3 and 5 times revenue. So you're getting very different treatment and very different value on really big companies like Databricks that are trading at really high multiples that have that AI type of spin to it versus everyone else. And by the way, you think Databricks is expensive now at 17 times, literally like 3 or 4 years ago. I think 2020 and 2021, I'm looking at my sheets here. I mean, these things were trading at 50 to 60 times revenue, the public comps and the private comps.
And that makes me wonder, I mean, maybe, I don't know what you're doing earlier stage at this point, but because some of the smaller, maybe less visible software names in the public markets, those comps aren't doing well now, maybe that's a great deal for investors because eventually in a different market, when some of these other companies that are now at lower valuations come public, they'll actually lift the ones that survive that are in the market now.
No, you look, you're spot on. There are two things that I would tell any investors in this marketplace, specifically with like companies like Klarna and Turo that are a little smaller versus a Databricks. One, with the smaller ones, it's the best relative value play right now. Literally, Klarna is bigger than its public competitor, is growing faster, is more profitable, but it's trading at a lower revenue multiple than Affirm. 3.8 versus 6.9, right? So great relative value for those fundamental investors looking to upgrade in that space. But then you got companies like Turo that are just completely mispriced right now. Turo is mispriced because it should be trading at Airbnb type multiples around 8 or 9 or whatever, but it's being dragged down by its public comp GetAround, which is having so many troubles financially, and it's much, much, much smaller. So I think you'll get the multiple expansion once they change it from being priced to something like GetAround to something like Airbnb. But Databricks is about one story. Multiple expansion if multiples get back to 2020 and 2021 levels. Currently, you're looking at a company that's trading, like I mentioned, 17 times, but it was trading at around 50 times just a few years ago. So if you think about the multiple expansion there, you got a company whose valuation is $43 billion in the private market that could be worth $120 just by multiple expansion if multiples get back to where they were in 2020.
But are multiples really going to go back to 2021? I asked that because we had interest rates at 0. You had just record amounts of liquidity sloshing around in both the public and private markets. It was a very atypical time period. So does that actually make sense to see us go back to that in terms of those multiples and those valuations?
Look, I think it's possible. You mentioned a couple of factors that are kind of leading the path for that to happen. But I think ultimately, if you look at the multiples of big tech, those haven't changed at all, right? Interest rates have literally done crazy things over the last couple of years. But if you look at the Apples and Googles and the Amazons of the world, their multiples are the same from 2020 to 2021. So once you break past that threshold of profitability and you're a mega type of technology company in an industry that's growing really fast, like AI, I do think AI has the opportunity to go back to those multiples. The other industries, I'm not so sure.
Okay. So I see the shirt you're wearing. Got to call that out. Atlanta Falcons, your limited partner. I'm not going to ask you about that team or the NFL specifically, but I am going to ask you about investing in sports because we've seen the reports about the Celtics potentially selling for a record valuation. We see the news even just today, Disney CEO Bob Iger and his wife looking to buy a women's soccer team. It all speaks to how much money, not just from individuals, but also from private equity, from investor groups, et cetera, is going into sports. I mean, how do you approach this? Are you thinking about it similarly to how you invest in the startup landscape as a VC?
Yeah, so this is not a game for retail investors. These are long-term illiquid assets that bring three main things to ultra high net worth people and private equity funds. The first thing is it's non-correlated to the stock market. The second thing is very similar to how software companies have annual reoccurring revenue. If you look at the NBA media rights deal, which is due to be renewed around this year, they're going to sign another 10 to 12-year deal. I mean, literally up to 3/4 of their revenue could be pre-baked out for 10 years. So that's a highly valuable asset that you can underwrite, just like you can do a stream of cash flow from bonds or any private equity opportunity. So that's very important. And then last but not least, these things are rare. It's literally like buying a mansion in Malibu, right? You're going to pay higher because it's Malibu versus something down the street. So the scarcity associated with these assets is 32 teams in one league, it's 30 in another. It's just not that many, right? I'm not going to even talk about the bragging rights. That's all obvious. But that's driving the valuations. And I know a lot of people keep thinking about the valuations and how bloated they are. I heard the same thing with late stage tech 7 years ago. But what people aren't seeing is what is the revenue growth from 10 to 20 years ago to today? These companies are valued at a multiple, these teams are valued at a multiple of revenue. So you're only seeing half the picture if you only look at valuation, but you don't know what the revenue is. I can tell you right now that the valuations are substantiated and that they will continue to grow based on how popular these leagues are and how valuable the media rights are for each league.